This voice is taken from an article with the title, "What is the role of risk-reward ratios in a candlestick pattern-based strategy?" which has been published on TraderTalks.net. The role of risk-reward ratios in a candlestick pattern-based strategy is critical to the success of any trader. Risk-reward ratios are one of the most important factors to consider when making trading decisions. A risk-reward ratio is a measure of how much risk is taken for every dollar gained on a trade. It is expressed as the ratio of the maximum loss to the maximum gain on a trade. In a candlestick pattern-based strategy, the risk-reward ratio measures the difference between the entry price and the stop-loss price, the maximum loss, compared to the potential profit, the maximum gain. The risk-reward ratio is a measure of how much risk is taken for every dollar gained on a trade. A higher risk-reward ratio means that a trader is willing to take on more risk in order to achieve a higher potential return. When trading with a candlestick pattern-based strategy, the risk-reward ratio is important because it helps to determine how much risk a trader is willing to take for a given reward. It can also help to identify potential trading opportunities. For example, if the risk-reward ratio is higher than 1:1, it may be an indication that the trader is willing to take on more risk for a greater potential reward. Similarly, if the risk-reward ratio is lower than 1:1, it may mean that the trader is not willing to take on as much risk in order to achieve a smaller potential reward. In addition, the risk-reward ratio can help a trader to assess the probability of a trade succeeding. For example, if the risk-reward ratio is higher than 1:1, it may indicate that the probability of the trade succeeding is greater than if the risk-reward ratio was lower than 1:1. This can be useful for a trader to determine if the potential reward is worth taking on the risk. Overall, the risk-reward ratio is an important factor to consider when trading with a candlestick pattern-based strategy. It is a measure of how much risk is taken for every dollar gained on a trade and can be used to determine the potential reward and the probability of a trade succeeding. By taking the risk-reward ratio into account, a trader can make more informed decisions and increase the probability of achieving a profitable trade.